Now, I will explain about identifying the accounts and classes of transactions involved in the sales and collection cycle. The main objective of this step is for auditor to understand which accounts are affected by sales activity and how transactions flow through this account. This helps ensure that all transactions are properly recorded and no material misstatements are overlooked. Based on the textbooks, there are 6 main accounts commonly involved. The first one is sales revenue, which record both cash and credit sales. The second one is account receivable. This includes the beginning and ending balance, and it is affected by credit sales, payment, receipt, returns, and write-off. The third one is cash in bank. This account reflects customer payment from both cash sales and collection on the credit sales. The fourth one is sales return and allowance, which is used when customer return goods or are given discount. The fifth one is allowance for uncollectible account. This is an estimate for receivable that might not be collected. The last one is bad debt expense. This is the cost of uncollectible account written off during the period. Next, there are 5 classes of transactions that typically occur in this cycle. The first one is sales transaction, which include both cash and credit sales. The second one is cash receipt, when the customer makes payment for their purchases. The third one is sales return and allowance. It is for return goods or discount given. The fourth one is write-off of uncollectible account. It is for customers who are unable to pay. The fifth one is estimate of bad debt expense, which is recorded as an adjusting entry at the end of the period. These transactions flow through the accounts I just mentioned, and every entry, especially credit sales, ends up affecting account receivable balance. That's why auditors pay special attention to this account in their testing. In summary, identifying the account and transaction types in this cycle help the auditor understand what to test, where error might occur, and how to design audit procedure effectively. Now, I will explain about business function and related document in the sales and collection cycle. This cycle includes all the steps a company goes through, from receiving a customer order, delivering goods, billing, collecting payment, and handling any return or write-off. Auditors need to understand this function to assess internal control and identify any risk of material misstatement in the financial statement. First, we have the processing customer order. That is where the company receives and records customer requests. The documents that involve are customer order and sales order. Second is granting credit. Before approving the order, the company reviews the customer credit worthiness. The documents used are sales order with credit approval and the customer master file. The third one is shipping goods. After credit approval, the goods are delivered to the customer. This process is supported by documents like shipping document, delivery order, and bill of lading. The fourth one is billing customer and recording sales. The company issue an invoice and record the transaction in the accounting system. The documents that are involved are sales invoice, sales journal, sales transaction file, and account receivable master file. Fifth, we have processing and recording cash receipt. When the customer makes a payment, it must be recorded properly. Documents are included is remittance advice, cash receipt journal, and bank slip. The sixth one is processing sales return and allowance. This happens when customer return goods or are given post-sales discount. The main document is credit memo, which is recorded in the sales return and allowance journal. The seventh one is writing off uncollectible account. If a customer is unable to pay, the company must write off the amount. The document that are used is uncollectible account authorization form, and it is recorded in the general journal. And the last one function is providing for bad debts. This is an adjusting entry where the company estimates how much it might not be collected in the future. It is recorded in the general journal. In summary, understanding these 8 business functions and their related document is crucial for auditor to test internal control and ensure the accuracy of sales and receivable.
Next, I'll be presenting about the internal control in the sale and collection cycle. Internal control is a process implemented by management to provide reasonable assurance regarding the achievement of the objectivity, including the reliability of the financial reporting, complying with law and regulation, and also the effective operations. In the sale and collection cycle, internal control are important to ensure that the sale transactions are recorded accurately, completely, and in the correct periods, and that the cash collection from the customer is properly safeguarded. Now, I will explain about the internal control according to the relevant audit assumptions, starting with the occurrence. The objective of the occurrence assumption is to ensure that the sale and cash receipt transaction actually took place. The internal control for the occurrence is each sale transaction is supported by the necessary documentation such as sale invoice, shipping document, and customer purchase order. This is to ensure that the record sales are valid and based on the actual transaction. Second, batch total of cash receipts are compared with the computer summary reports. These help confirm that all recorded cash receipts are based on the real transaction and no fictitious amount are recorded. Now, for the classification, this is to ensure that the transactions are recorded in the correct account. The first one is the cash receipt transactions are internally verified. This review the process ensure receipts are recorded in the appropriate accounts such as separating customer payment from loans or other income. The second one is the segregation of duty between the sales function and the accounting department. This is to reduce the risk of error or fraud by ensuring no single person has control over all aspects of transactions. And the third one is the proper classification is important to produce accurate and meaningful financial reports. Next, we look at the completeness assumptions. These ensure that all the valid sale and cash receipts are recorded and nothing is left out. The internal control related to the completeness is include the pre-listing of the cash receipt is prepared, which to provide a complete record of all cash receipts before it's recorded in the accounting system. Checks are retrievably endorsed upon receipts. This limits the possibility of misappropriations and ensure that the checks go directly in the company account. The third one is the customer statement are sent regularly. This to allow the customer to detect any missing payment or error in their account balance. Then lastly is a matching of batch total with the system generated summaries. Next is the accuracy assumption, which ensures that the transactions are recorded at the correct amount. The following internal control help ensure accuracy by the accountant independently reconcile the bank account. This to ensure that the cash recorded in the book match the amount deposited in the bank. Second, batch total of the cash received are compared with the computer summary reports. This to double check that the input and the output of the data match exactly. And the third one is the customer statement are sent out. This acts as an external confirmation of the amount recorded by the company. Accuracy control helps to prevent both overstatement and understatement in the sale and collection cycle. Lastly, the cut-off or a timing assumption. This is to ensure that the transactions are recorded in the correct accounting periods. The internal control includes procedure required recording of the cash receipt on a daily basis. This helps ensure a timely recording of the cash and prevent a deferring or advancing a receipt between the periods. The second one is the goods must be shipped before billings. This to ensure that the revenue is recognized only when the risk has passed to the customer in accordance with the review recognition standard. And then lastly is the reconciliation of the shipping dates with the invoice dates. Next, I will be presenting about the test of control in the sale and collection cycles. A test of control is an audit procedure performed by the auditor to assess the effectiveness of the client internal control. The goal is to determine whether these controls are working as intended to prevent or detect material misstatement in the financial statements. In the sale and collection cycle, these tests focus on control over the recording of the sale, billing, and collection of cash from the customer. Now, I will explain about the test of control according to the 5 key audit assumptions: accuracy, completeness, accuracy, classification, and a cut-off or a timings. Let's start with the occurrence assumptions, which ensure that the recorded sales and receipt actually took place. The test of control under occurrence include inspecting a sample of recorded sale invoice and tracing them to the customer purchase order and delivery order. This to confirm that each recorded sale is supported by the actual document, proving that the transaction was real and valid. The second one is examining the file of the batch total for the initial of the data control clerks. These tasks help that the auditor verify that no fictional sales or collection have been recorded. Next is the completeness assumption, which makes sure that all actual sales and receipts are recorded and nothing is omitted. The test of control here includes observing the pre-listing of cash receipts. This helps confirm that all cash and check received are documented before processing. The second one is observing the endorsement of the incoming checks. This to ensure that the checks are properly marked as belonging to the company, preventing misappropriation. The third one is examining the file or batch total for the initial of data control clerk. This again confirm review and approval, helping ensure that all batches are recorded. This procedure helps the auditor ensure no genuine transactions are left out. The third assumption is accuracy, which ensures that sale and carry receipt transactions are recorded at the correct amount. Tests of control for the accuracy is include inspecting a sample of invoice and verifying the pricing against the approved price list. This to ensure that the customer are charged the correct amount based on the company policy. The second one is examining the file or batch total for the initial of the data control clerk. This shows that the data was reviewed and correctly entered. And the third one is the observing whether the accountant reconciled the bank account. This to help to verify that the amount of the cash record match the actual deposit in the bank. This procedure helps detect error in the pricing or data entry that could affect the financial statements. Next, we have the classification assumptions, which ensure that the transactions are recorded in the correct account. The test of the control is include examining whether the chart of the account is used correctly during the data entry. This to ensure that the revenue and cash are posted to the appropriate ledger account. The second one is observing the data entry process for the proper coding and classifications. This helps verify that the staff are using the correct account coded during the transaction process. This test reduces the risk of the financial misstatement due to the misclassification of revenue or receipts. Finally, cut-off or timing assumption, which ensure transactions are recorded in the correct accounting periods. The test of the control is include inspecting the sequential numbering of invoices or shipping documents around the period ends. This allows the auditor to identify whether any invoices were recorded in the wrong periods. The second one, matching the delivery date with the invoice dates. This to ensure that the revenue is only recognized when the goods are actually delivered. And the third one is observing the unrecorded cash at a point in time. This helps detect any delay in recording cash receipts. This procedure helps ensure the compliance with the match principle and accurate periods reporting. In conclusion, the test of control in the sale and collection cycle provide the auditor with evidence about how effective the client internal control are.
I would like to share about substantive tests of transaction. Substantive tests of transaction are audit procedures designed to detect material misstatement at the essential level for individual transactions in the financial statement. These tests aim to verify the validity, accuracy, completeness, and proper classification for each transaction. First, substantive tests of transaction for sales are audit procedures performed to detect material misstatement related to sales transaction in the financial statements. Let's go through them one by one. Number 1. Occurrence. This assertion ensures that the record sales actually occur and are not fictitious. In other words, the sales recorded in the sales journal must represent actual shipments made to real customer. To test this, auditors review the sales journal and the master file for any unusual transaction or amounts. They also trace sales entries to supporting documents such as duplicate sales invoice, bill of lading, sales order, and customer orders to confirm that the sales took place and the goods were delivered. Number 2. Completeness. For the completeness assertion, the objective is to verify that all sales that occurred have been recorded in the accounting system. Auditors perform this by tracing selected shipment documents to entries in the sales journal to be sure that each one is included. Third, accuracy. The accuracy assertion ensures that the sales are recorded at the correct amounts based on the quantity of the good shipped and the agreed price. To verify this, auditors trace entries in the sales journal to the original sales invoice. They recompute the prices and extensions on the invoices to check for mathematical accuracy. In addition, they compare the details on the invoice with the related shipping documents, sales orders, and customer orders to make sure everything matched correctly. Number 4. Posting and summarization. For this assertion, the auditor wants to ensure that all sales transactions are correctly posted into the accounts receivable master file and accurately summarized. To test this, auditor traced a selection of sales invoice from the sales journal to the account receivable master file and verify the details such as amount, date, and invoice number to confirm that the data was correctly posted and summarized. Number 5. Classification. Under the classification assertion, the goal is to confirm that sales transactions are recorded in the correct accounts. This involves examining duplicate sales invoice for proper accounts classification. And the last one, timing. The timing assertion ensures that sales are recorded in the correct accounting period. To test this, we compare the date of the sale as recorded in the sales journal with the date on the duplicate sales invoice and the bill of lading. This helps confirm that the sale was recognized on the correct data, neither prematurely nor delayed. Next is about set-setting test of transaction for cash receipts. Number 1, occurrence. This test ensures that recorded cash receipts actually occur and were genuinely received by the company. The auditor reviews the cash receipt journal and master file for unusual transactions and amount. They trace entries from the cash receipt journal to the bank statement. A proof of cash receipt is prepared to confirm the existence of the transaction. Number 2 is completeness. This test ensures that all cash receipts have been recorded in the cash receipts journal. The auditor obtains a pre-listing of cash receipts and traces the amounts to the cash receipts journal, checking names, dates, and amounts. The last one, the pre-listing, is compared with the duplicate deposit slip to ensure no transaction were missed. For the third one, accuracy. This test checks that cash receipts are deposited and recorded at the amounts received. The auditor used the pre-listing to trace amounts to the cash receipt journal, verifying names, dates, and amount. A proof of cash receipt is also prepared to confirm recording accuracy. Number 4, posting and summarization. This test ensures that cash receipts are correctly included in the accounts receivable master file and are correctly summarized. The auditor traces selected entry from the cash receipt journal to the accounts receivable master file and checks for correct dates and amounts. Number 5, classification. This test verifies that cash receipt transactions are classified into the correct accounts. The pre-listing is examined to ensure proper account classification. And the last one, timing. This test confirms that cash receipts are recorded in the correct accounting period. The auditor compared date of deposit per bank statement to the dates in the cash receipt journal and pre-listing of cash receipts. Test of details of balances. This involves examining supporting documents and performing procedures on ending account balances to obtain audit evidence about their correctness. This focuses specifically on verifying the correctness of account receivable through 4 main audit sessions. Number 1, existence. Verifies that the recorded accounts receivable actually exists. A sample procedure can relate with confirmed balances directly with customers. Number 2, completeness. Ensures that all existing account receivable have been recorded. Example, review shipping documents near year-end to confirm no sales were omitted. Number 3, accuracy. Confirms that the amount in the account receivable are recorded accurately. Example procedure is match customer invoice to ledger balances. The last one, classification.
Now, I will be discussing some critical internal control weaknesses identified within the sales and collection process, and I will be discussing the impact or consequences on the organization and also recommendation to rectify the weakness effectively. Let's start with the first weakness. First, lack of segregation of duties between sales and collections. When a single individual is responsible for both recording and handling cash or collection, it significantly increases the risk of fraud, misappropriation of funds, or undetected errors. This is because there are no independent verification of the transaction involved. To address the issue, the organization should implement proper segregation of duties by assigning the different sub-forces entry approval and payment reconciliation. Additionally, there should be independent review or reconciliation conducted by another department to ensure transparency and accountability. Next, the second weakness is manual reconciliation of bank payments by the sales staff. This method increases the risk of human error, delayed identifications of missing payments, or even intentional misstatements of receipts. To rectify this payment, reconciliation should be automated and performed by someone who is not involved in recording sales. This will minimize bias and reduce errors. On top of that, a regular audit should be conducted to ensure everything is accurate and complete. Lastly, the third issue is the operator has the authority to approve or void telephone orders without any supervisory review. This weakness will open the door to unauthorized or fraudulent transactions, manipulation of sales data, or inconsistent order processing.
To solve this, the organization should implement a system where supervisory approval is required for bots or any unusual transactions. It also essential to maintain audit trails to track all changes made to orders for future reference and accountability.
The fourth weakness is that system automatically accepts online orders and payments with no manual review. While this speeds up the process, it increases the risk of errors such as processing incorrect or fraudulent orders, which may lead to customer complaints or financial loss. We recommend including a review checkpoint for high value or suspicious orders before they are finalized and shipped. The last weakness is the lack of formal credit control follow-up and overdue accounts. The case clearly states that there is no structured follow-up for overdue accounts. As a result, this may lead to delays or failure in collecting outstanding debts, which increases the risk of bad debts and negatively affect the company's cash flow management. We suggest establishing a dedicated credit control department to perform formal follow-ups through phone calls, reminder emails, and letters of demand. In conclusion, addressing these 5 weaknesses will greatly improve Persada Sedan Berhad's internal control over its sales and collection cycle. It will reduce the risk of fraud, enhance debt collection, improve customer satisfaction, and strengthen the company's financial management.